Have you ever wondered, what does EBITDA, earnings before interest, taxes, depreciation, and amortization, really actually mean? What is an asset and what is a business expense? And how in the world, as a small business owner, am I supposed to navigate all of these complex terms? Well, today I've got you. You're listening to Business by the Books, the podcast that teaches you how to use your financials to manage your business. My name is Danielle Hayden. I am the founder of Kickstart Accounting, Inc., where we use bookkeeping as a vehicle to help business owners take control of their numbers. And I've helped thousands of entrepreneurs make informed financial decisions for over a decade. Today, we're going to be talking about when you should invest in assets and when you should focus on business expenses. You'll walk away with understanding what is a fixed asset, how assets build the value of your business, and why you might not need assets in your business today. I have Victoria here with me as my non-accountant client advocate to help ask all the questions to help you, the listener, get a better understanding of fixed assets, business expenses, and depreciation. Before we jump into my conversation with Victoria, I want to do a quick definition of what is a fixed asset and what is a business expense. So a fixed asset is a long-term tangible, so touch it, feel it, or intangible asset that is used in your business. It's not intended to be sold, so it's not going to be included in your revenue, and it is expected to be used for over more than 1 year. So these are your high-performance computers, graphic design software licenses, custom software development, office furniture, and large equipment. Fixed assets help contribute to the value of your business because they are recorded as an asset on the balance sheet. These assets are then depreciated or amortized over their useful life. So they are taken over the useful life from being an asset as a business expense. Now, business expenses in general are costs incurred in just the ordinary course of running a business. So these are short-term, reoccurring. We use them month in, month out. We're using them as we are growing our business. So these include cloud storage fees, digital advertising, professional membership, software subscriptions, like all that day-to-day stuff that we use to run our business. So most business expenses are tax deductible this year. They reduce the business's taxable income. So our general business expenses we're taking this year, their useful life is this year, and therefore we're taking the business expense this year, and it is reducing our taxable income this year. Our fixed asset will sit on the balance sheet for future use, and therefore we're going to match the future use of that asset to the time period for that business expense. So we're going to move it from asset to a business expense and take the tax incentive that year. All right, Victoria asked me all the questions here. So here's my conversation with Victoria about all things fixed assets and business expenses. I don't normally do this, but I want to talk about this in terms of like a brick and mortar business and then an online business because they're very, very different in terms of fixed assets. So when we have a client who is opening up a location or maybe a second location, all of the leasehold improvements, everything that they're doing to build out that location is considered a fixed asset on the balance sheet that's capitalized. So that means you don't receive the business expense in that year. You're putting it on the balance sheet as something that the company owns, and you'll take that business expense through depreciation over time. But the minute that location opens, any additional repairs or decorations or anything that you buy becomes a business expense and no longer a leasehold improvement unless it's a big purchase, such as like a large computer or system or piece of equipment.
So how do you determine that cost threshold?
So we have a standard as a firm that anything over $1,500, we will discuss with our clients. So you want to make sure that as a business owner that you have a policy. So here at Kickstart, we have a policy that we don't capitalize our computers. Most of our computers that we purchase are under that threshold, and therefore our policy is that we expense them the year that we purchase our computers. However, you might be buying, if you're a creative business, you might be purchasing higher level computers, like such as MacBooks, and they're at a different price point. So they're $2,000, $2,200, $2,500 per computer, and therefore, if your policy as a business is that anything over $1,500 is capitalized, then all those computers would then be capitalized. We handle this across all of our clients. So if you're a client of Kickstart, you actually do have a policy. And your policy is $1,500. So if it's over $1,500, if it's like $1,600, $1,700, we might still expense it the year that it incurs. Because if you're really profitable, you want to have that business expense this year. But if you're purchasing a piece of equipment that can be depreciated over time, like a computer, then we'll capitalize it and have the tax accountant depreciate it.
Okay, so when you put that policy in place, is that something that you have to consistently follow every single time, or are you able to make those decisions based off of, what was purchased, or maybe adjust your policy as your company grows?
Yeah. So in accounting, you can have what's called like a change of accounting procedures. But if you were audited, or if you were audited by the IRS, or if you ever had to have your financials reviewed or audited, if you were having a change in policy year over year, that really wouldn't be allowed. It's not allowed by the IRS. They want consistency over time. So we can't have a change in accounting procedures or policies each and every year of whatever suits you. It's just like with the mileage versus vehicle expense. You can't do mileage one year and then expense your car the next. Just because you spend $1,800 on something doesn't mean that it should automatically be capitalized. If you're only going to use it that month or that quarter or that year, it should not sit on the balance sheet, because the idea of the balance sheet is that you're going to carry that value into future years. And so the goal of the depreciation is to match the usage of that asset.
Okay, so the depreciation is determined by how long you can potentially use it and the value that you're getting out of it over time.
Yes. So if you purchase, let's say, a computer and you expect to use that computer over the next 3 years, or a piece of equipment. So maybe you buy a large camera or a large piece of equipment for your business. If the average use for that piece of equipment is 3 years, your depreciation would be over 3 years. If the average useful life for that piece of equipment, useful life just brought me back to accounting class. If the useful life of that piece of equipment is typically 5 years or 10 years, your depreciation would match that over time. And depreciation sounds like this really big word. It's really just taking the entire value of that asset, that purchase, and dividing it over 5 years. So if you're saying 5 years is the useful life, I'm going to use this tool for the next 5 years. You're just taking how much you purchased that piece of equipment for and dividing it over 5 years, and that's your depreciation for each year.
I might be getting a little too in the weeds here, but how does that work if you have to get a loan, or you're borrowing to purchase the asset?
No, that's a great question. It has no impact on whether or not you categorize that as a business expense or an asset. If you take out a loan and then purchase that piece of equipment, you'll have the asset, the purchase value of that piece of equipment, sitting as an asset on your balance sheet. And then you'll have a loan sitting on the liabilities section of your balance sheet. So if you took out a $10,000 loan to purchase one piece of equipment, you would have the purchase price of that asset, so the $10,000, you would have that sitting on your balance sheet as equipment, as an asset. So it's something your business owns, that $10,000. And then let's say you put $1,000 in cash down, and then you took out a $9,000 loan. So they made you put $1,000 down to guarantee the loan. So that $9,000 of debt is now sitting on the liabilities section of the balance sheet, meaning that you owe somebody else those dollars. And it's impacting the entire value of your balance sheet because you're increasing your debt. So now not only do you have a depreciation schedule, but you also have a debt schedule in the future.
Okay, that makes sense. So how does this affect online businesses?
So online businesses, you might still purchase a large piece of equipment or something creative. As you're creating your online business, you might need a large piece of equipment for your computer, or maybe you're building out your own software. So this is something that we've had several of our clients do, where they've worked with in another organization to build out their software, and the costs to build their own proprietary software is an asset and then will be depreciated over time. So the cost of paying that team to create the software will now become your asset.
So you were talking about, leasehold improvements and kind of like renovations. So what about our business owner that works from home and they want to make improvements to their home office?
Yeah, depends on how we're structured. So if we're an LLC versus an S-corp, it's going to change what we can take. Traditionally speaking, I like to use my office as an example because if you watch us on YouTube, you know that I am always sitting in the same blue walls. I never move. I am always here, and definitely use this room more than any other room in my entire house. And we are structured as an S-corp. So this space of my house, the business can pay me, Danielle Hayden, personally for rent usage of this space. And therefore, when I purchase this desk, so this desk that I'm sitting on, this desk is a business expense. And because I only spent like $500 on the desk, it's just an expense for that year. But as an S-corp, the business pays me rent for usage of this space. And I configured that number by looking at how much it would cost Kickstart if I rented a space down at a co-working space here in Cleveland. So if I rented another space, how much would that office cost me to rent out? And that's how much the business is able to pay me as a business owner. And we do that only because we are structured as an S-corp. If you are an LLC or you don't have this type of office space, right? You want to know how much space of your home that you are using for the business only. So remember, if you're sitting at your kitchen table, you cannot write off your entire dining room or your kitchen, and therefore you cannot write off your kitchen table. So if it doesn't feel right, it's not right. Like if you feel like you're operating in the gray, it's in the gray, and it's probably not a business expense. We'll get back to the show in 1 second, but real quick, are you a business owner feeling overwhelmed by your finances? Do you find yourself wishing you had more control and understanding over your money? Managing your business finances can often feel like navigating a ship through a storm without a compass. But what if instead you could master your business finances in just 5 days? With the confidence to manage your money, make informed decisions for financial stability, and implement strategies to increase your profitability effortlessly. And that's exactly why the 5-day video bootcamp was created. It's a comprehensive course designed to empower you with the foundations for financial success. Throughout the bootcamp, you'll learn the foundations, how to manage costs for profitability, evaluate investments for growth, and avoid common financial pitfalls. So if you're ready to take charge of your financial journey and rewrite your success story, head over to esuite.co/5-day bootcamp or click the link in the show notes and sign up for the bootcamp today.
Yeah, if you're looking for a workaround, then it's probably
right.
A little iffy.
Yeah. So just keep in mind, if you have a space or you're purchasing something that you are only using for business. So again, if you're purchasing a desk to put in the corner of your dining room, and the only use for that desk is going to be for business, then yes, that's a business expense. But if you're going to repaint your dining room and you're using your dining room for both business and personal, you can't write off the paint or the remodeling of that room.
Right. So if something that you're buying for your home office that's only for business use meets that asset threshold, then it can be an asset.
Correct. Yes. The only other scenario that I can think of is for a business that's opening up a second location or an online business that is opening up a brick and mortar. So we do have some online e-commerce clients who then open up a local brick and mortar store. And there's some questions around inventory or usage of the tools and equipment that you were maybe packaging from home and now we're bringing into the brick and mortar space. And it's really the same rules apply as you're building out the space. Anything that you purchase is going to be the leasehold improvement. Anything that you've purchased in the past that you're using for packaging or for storage, they were already a business expense. So you're just going to move them from your home office into the brick and mortar location. You would not move that expense from a business expense and then go ahead and capitalize it. If you've already expensed it, leave it as an expense.
Right. So why do you think that fixed assets and depreciation schedules and all of that seems to confuse people so much?
It feels like something that big companies do. I think that we've encountered more than anything, and this has surprised me every year of this business, is the mindset that goes around owning a business and for small business owners of, I'm not big enough, right? Like I'm too small to worry about this stuff. I don't need to build my balance sheet. I don't know what a balance sheet is, so I don't understand it, and so I'm just not going to deal with it. And any longtime listeners know that ignorance is not an excuse for a business owner. We have a responsibility. The minute that you took out your LLC filing, you've become a responsible business owner, and we have to conduct ourselves as such. And so it's really important that we are looking at what a balance sheet is and how it contributes to us as a business. And so I think that's why it feels so hard to wrap our heads around this. It's just that we're minimizing our business. And I know that anybody who's listening, you're on the trajectory for growth, because if you're listening to a podcast like this, you're in it. You're in it to win it. You are setting yourself up for success. And we need to shift your mindset into one that understands balance sheets, that understands how to build a valuable company. We have seen some of our clients who start to think about what's going to be next for them in life. And so if they're thinking that long term, they might want to sell their business. And I really encourage anyone who's listening, don't ever walk away from your business. You have an asset to sell. We don't ever want to just walk away from a business, even if you've decided that you don't want to run or own it anymore. So some of our clients have started to look at, should I be building assets so that my business is more valuable to sell in the future? And that's not always the case. So just because you have a large amount of fixed assets or you have a lot of leasehold improvements doesn't mean when somebody comes to buy your business that they're going to value your business for more, right? Like they're not like, oh my God, they have all these fixed assets. That's not what they're buying. What they're buying is brand reputation. They're buying your SOPs. They're buying your client base. They're buying more than just the balance sheet. And I can't remember the episode number, so we'll put it in the show notes where we talked at length about building a valuable business outside of the balance sheet, so that if and when clients are ready to sell their business, they're able to build up that value and get the maximum amount of value for their business.
So really the key takeaways here are consistency And a lot of it is about considering the future and your current conditions versus your future conditions. If you're super profitable now, or do you take the expense over time?
Yeah, exactly. I mean, think about where you want to go. You know, if you're really profitable this year, you might want to just take the expense this year, but where are you going, right? Because if this year was an anomaly and you don't plan on being profitable again next year, I mean, let's have a conversation about why you think that and fix the real problem. But if you are not sure about how profitable next year is going to be, or you're not sure about your future growth, then it might make sense to take the expense this year. If you're a business owner who is really intentional about building a growing business and your goal is to continue into the future and really have longevity in your business and continue to be profitable, it will make more sense for you to capitalize these expenses and have the depreciation over time.
Yeah. So what are the next steps for clients? What should they be considering when they make purchases?
I never want anyone to make a purchase to build their balance sheet. So do not go and buy something because if you're comparing between two purchases and one's 1,400 and one's 1,900 and you buy the 1,900 one because it's going to be a fixed asset, I never want you to spend money to save money on taxes, or I never want you to spend money just to build a balance sheet. We want to be intentional with the way that we spend money as business owners. So every time you're spending a dollar, you're spending that dollar because it makes sense. It has a place in your business and you're able to put that dollar to work in the business. So as you're making purchases, you didn't make the purchase because of the balance sheet or because of the tax write-off. You made the purchase because you need it in your business. Once you've made the purchase, I want you to talk to your money team. So if you're a Kickstart Accounting Inc. client, I want you to talk to your money team about whether or not this is going to be a business expense or a fixed asset and why. And if you're not working with us and you're working with another team, make sure that you're having that conversation. And if you're doing your bookkeeping on your own, it's really important that you're categorizing this correctly and that you're using the right reports on your tax return, because this is where it could be a very slippery slope. We recently took on a new client who has all this inventory on the balance sheet. And for the last several years, she was doing her own bookkeeping. She was putting all of her expenses for her product as an inventory, thinking, I'm building the value, right? I'm building this asset on my business. And so I'm categorizing everything as inventory. Well, she never made any cost of goods sold entries. So she never relieved the inventory for what she actually sold. So as she sold the product, she didn't move it from inventory to cost of goods sold. And her tax accountant, who I don't blame because the tax accountant's only job is to file the tax return. And so he filed the tax return with all this inventory on the balance sheet, and she missed out on all of those business expenses. And so now she's either going to have to amend previous returns or take a large adjustment this year and hope that it doesn't raise an audit red flag. So if you're doing your own bookkeeping, your tax accountant's job is to file the tax return, not to review your work. And so it's really important that you're working with the right team to make sure that things are categorized correctly and you don't end up with things on the balance sheet that should really be a business expense, because cash dollar, like talk about real money coming out of your business bank account to go to the IRS that it shouldn't have.
Right. So whose responsibility is it at the end of the day to make sure that they have all of the depreciation schedules and that they're keeping record of everything?
Always you as the business owner. And I know I'm going to piss a lot of people off, but it's always your responsibility. And look, it's coming from somebody who really hates this. Like it is a pain in my behind. Like it is painful when I have to do these types of tasks. So I get it. Visionaries, you want to be doing ideas. Creatives, you want to be doing the creative work. When you have to sit down and keep track of the taxes and the depreciation schedules and the admin stuff and where's everything, where's all the electronic files and all of that documentation, I get that it's super painful, and why I love my operations team so much. um, However, it's still my responsibility. And I know that. So when something doesn't get done or I can't find something, I always know that it's my responsibility because I, at the end of the day, own the business. And so for everyone who's listening, ultimately, it's not your tax accountant's fault. It's not your bookkeeper's fault. It's always your fault, because when you move from one tax accountant to another, you need to make sure that you have all of your electronic returns, all of their work papers, all of their depreciation schedules, so that you can bring it from one firm to the other. And every time your return's filed, you need to make sure that you have copies of all of that. We see this all the time with our clients where they haven't moved to our tax firm and they're using another CPA, which is fine. Totally okay with it. However, if we never get the depreciation journal entries from the tax accountant, your bookkeeper doesn't know to enter them. And your QuickBooks might not match your tax return. And so it's your responsibility to make sure that your bookkeeping team has everything from the tax team so that they can make sure that your books are accurate.
Right. So, shameless plug, but that is one advantage of working with a team that can do both. And we have a great team that kickstart clients. If you have any questions, go ask your bookkeeper. We're starting mid-year check-ins. By the time this episode is out, they will have been started. So always kickstart clients, KSATP clients, get with your teams. They are awesome at what they do. But also as a business owner, record keeping is so important, especially we talked about selling your business earlier. You're going to need those records. If you go to sell, if God forbid something happens to you and then someone else is filing your taxes on your behalf next year, you want to make sure that everything is organized and squared away.
Yeah, that due diligence checklist is a bear. Yeah. And I know a lot of us, we're accidental entrepreneurs. And so you don't think about that. Like, I might want to sell my business in 5 years, 10 years, 15 years, 20 years. And you forget to get copies of the contracts, or you don't think it's important. And again, I'm right there with you. I understand how hard it is. Do it anyway. We do hard things.
Yeah. All right. Is there anything else that you think the listener should know, Danielle?
Talk to your team. If you have any questions, whether you work with us or not, talk to your money team. Make sure that your tax team is collaborating with the bookkeeping team. Your money team should be working together. So make sure that they have all the records together, so that you have a full picture of where your business is at. Your money team wants to help you, right? Like, we are so lucky to do what we do. We genuinely want to help our clients. And so use the resource that you have available so that your money team can be there to support you.
All right. Awesome. Thank you so much for having me, Danielle.
Yeah, of course. Thanks for being here. I have a favor to ask. If you have gotten any value from this show and you want the show to continue to grow and keep providing you with strategies for financial growth and efficiency, simply leave us a rating and review if you're listening on Apple or Spotify. Those reviews really go a long way in attracting more listeners, and honestly, they really make my day. So if you're feeling up to it, we'd love to see a rating and review from you. Either way, thanks so much for listening to the show.